Hello and welcome to FT Markets. Well, black gold is losing its luster. Oil prices continue to fall, and that's raising the pulse rates of investors in some of the big booming areas of the bond market in recent years, high yield bonds and leveraged loans. Joining me now to discuss the ramifications if oil prices continue to fall, I'm joined by Tracy Alloway, who's our resident expert on all things geeky and credit. Tracy, what's happening here?
Sure. Well, I think what we've seen is quite a stunning decline in the price of oil over the past 3 or 4 months. And that has been quite an unexpected development for actually the credit market, because it turns out a lot of energy companies have been issuing bonds and securing loans from investors over the past few years to fund their expansion. And in particular, some of the shale gas companies that we hear so much about have really been depending on the credit markets to fund their growth recently.
And when we look at the actual energy bond market or junk bond market for energy bonds, it's been quite a noticeable pickup in issuance by the energy sector. We've gone from roughly 4% to 16% over the last decade or so?
Yeah, that's right. So energy bonds accounted for 4.3% of the total junk bond market in 2004. Now it's up to 15.7% of the 1.3 trillion total junk bond market. That's quite an increase. And we've seen a similar trend play out in the leveraged loan market. So here, the energy sector now accounts for 4.6% of outstanding leveraged loans, compared with about 3% in 2004. So it's not as marked as in the high yield bond space, but it's certainly picked up.
Now, also what's interesting is that about a third of all the bonds that are currently trading at distressed levels in junk are actually related to the energy sector.
Yeah.
Which is it's quite a troubling sign here for the market overall.
Yeah, this is what everyone is starting to worry about now. So we've had years and years of low interest rates now. The corporate default rate in the US has been very, very low because it's easy money. You can go to bond markets at any time. You know, debt financing is pretty cheap. Now we're starting to see quite a few analysts who are saying, well, is the distress in the energy sector the thing that finally sparks an increase in the US default rate? And you know, it could be. A lot of people are drawing parallels with the telecommunications sector in the early 2000s, where telecoms companies issued tons and tons of bonds and then got into a little bit of trouble. There were a bunch of bankruptcies, and they ended up causing quite a bit of turmoil for the wider credit markets.
So the fear here is we could be seeing a big sort of restructuring default wave coming through the energy sector if oil continues to. So if we look at the oil price, can we draw a sort of direct comparison? If oil prices go below, say, $60 a barrel or maybe 50, is that when investors could really be in trouble if they're still holding what are generally illiquid positions?
Yeah, we had the credit analysts at Deutsche Bank recently say that if oil fell to $60 a barrel, that could start to really cause a lot of pain for companies who have built their business model on something closer to $90 or even $100 a barrel. It seems a bit of a random distress point, but certainly people are watching the price of oil now and wondering what happens in the credit markets. There's also concerns about potential contagion effects. So a lot of banks are on the hook for leveraged loans that they've issued to these companies and might not be able to syndicate. So for instance, we've just seen Barclays and Wells Fargo are said to be facing quite significant losses on a loan that they made to 2 energy companies to fund one of their mergers. So it's really the contagion effect that people are starting to worry about now.
Yes, and which, as we saw back in 2008, that's when a small pocket of turbulence or turmoil actually becomes a much bigger problem. And it's quite extraordinary, 6 years after the financial crisis, we could yet be facing another example where banks have been willing to extend credit and yet are now potentially exposed to quite a nasty blowback.
That's right, and it's worth just adding here that even before oil started falling, regulators were making a lot of noises about risky lending by banks in the leveraged loan space. They are worried about exactly this kind of scenario where banks get stuck with some risky loans that they aren't able to pass on to investors. That's exactly what happened in 2008.
Great, Tracy. Well, thanks so much for talking us through this. It's certainly a hot topic, and well, I suppose we just have to continue watching that oil price, and it could very well set us up for some quite hairy moments in the coming months.
Indeed. Thanks, Mike.